Good afternoon, everyone. Thank you for tuning in to our election special On Point webinar. My name is Matt Staninger, and I'm the Market Research Analyst at Oak Street Funding. I'm excited to be here today with two familiar faces, Steve Blake, Managing Director at CBIZ, and Marc Chandler, Managing Director and Chief Market Strategist at our sister company, Bannockburn Global Forex. These two have no small task today to attempt to summarize the potential implications of the election from a tax and market perspective. To start, we recently had a Federal Reserve meeting where they decided to lower rates by 25 basis points. I do want to take a moment here to remind our listeners the Fed works independently of the government, so the timing with the election is unrelated. But knowing we have one more Fed meeting left this year, can you provide a brief market outlook as our viewers are looking into 2025? Marc, I'll start with you.
Sure. So I think you're right to emphasize that the Federal Reserve is independent. That means independent from the political partisanship. It's got two mandates from Congress: price stability and full employment. And the Federal Reserve has become more confident that its inflation target is like they're on target for that. They're heading towards it. They feel confident of that. And that gives them the opportunity to really recalibrate and look at the other mandate, full employment. And the labor market has been skewed by storms and the recovery from the storm. So we really don't have a clean read. But as you said, the Federal Reserve cut rates 50 basis points in September to begin off the easing cycle. They cut 25 basis points this week. And the market still leans towards another 25 basis point cuts in December. And to keep in mind, though, the Federal Reserve is not regarded as easing policy. What they will argue is that what they're doing is removing some of the restriction. And the restriction is that monetary policy at its peak was set when the U.S. economy looked like it was overheating. This is less the case now. And so they want to remove some restriction to try to prolong a soft landing. I think that Powell will distance himself from trying to any hypotheticals and focus really on policy implications. So not to be baited into what happens if tariffs go up or this or that policy is pursued, but really focus on the economic data as it comes out.
How many rate cuts do you expect as we move forward?
Yeah, it's a good question. The Federal Reserve has what they call the summary of economic projections, which is they basically poll themselves and then give us the median and give us the range of their views. And in September, the last time they did this exercise, the median Fed view was for a 100 basis point cut in 2025. This, of course, is not carved in stone. It's not a commitment. It's just really their best guess, given that data set that they had in September. By the time we get into next year, we might have it'll still be early to get a sense of the policies and the sequence of policies and the economic impact. But the market still feels confident that rates are going to be headed down, even if we get tax cuts and a somewhat stronger economy.
Can you both speak to any immediate or long-term implications of these rate cuts for the average consumer, as well as from a business owner perspective?
Yeah. So, there's when we buy something, I bought this suit, I knew that I was paying a retail price. I think with a lot of households, a lot of small businesses, what they might not appreciate is that there's a retail and a wholesale price for money. The wholesale price of money is what banks charge each other. Right now, it's about 4.75%. That is the wholesale price for money. The retail price for money is what my credit card tries to charge me, over 20% at an annualized rate. And so what happens then is that as the Federal Reserve cuts interest rates to us consumers tends to fall at a much slower pace. The retail price for money remains expensive. And even for small businesses, the decline in interest rates that we've seen earlier this summer have not really fully been passed on to businesses. Small and medium-sized businesses might still be paying close to 10% to get access to capital. And so I'd say it's a bit of the old trickle-down problem. That you can cut the wholesale price, by the time it doesn't really feed through the retail sector for small businesses for quite some time.
Yeah, and I would reiterate some of those concerns as well. I mean, it's going to take time, but eventually we should start seeing some of those consumer and retail rates dropping. So it'll be cheaper for people to buy retail. I work a lot in the dealership space. So I work a lot with RV dealers. They're one of the leading indicators of the economy. What we've seen over the last few years is with higher rates. I mean, you're buying an RV, that's a large purchase that you're financing. When you're paying a higher rate, fewer people are going to make that decision and pull the trigger to spend that money at that higher rate, especially if you're locking in it for 5, 7, 10 years. So we're hopeful that as we go forward and we start to see these rates drop, consumers will be a little more willing to spend retail, especially on those larger purchases, which will obviously then turn into revenue for our small business owners.
Absolutely. Now, as we move on to the election impacts, can you just give a brief overview of the three main impacts of a Trump term? What should business owners expect to see? Steve, I'm going to start with you on this one.
So I think the big three that we hear about a lot with the Trump campaign and that we've even seen since the election, we're talking tax cuts, tariffs, and immigration reform. Probably the big three things. The tariffs and the tax cuts are kind of interrelated, and we'll get into the tax cuts more, but the tariffs also will impact our business owners because that'll impact the cost of the materials they're purchasing or that their manufacturers are purchasing going into their products.
Yeah, I would add two other things to that. I agree fully that those factors seem to be important drivers for what we should be expecting. Two other things that occur to me would be one is a more deregulatory environment. And businesses tend to like this lower regulation, thinking that they can regulate themselves better than the government can. And so I think the Trump campaign has promised, I think, to remove 10 regulations for every new one that they add, some kind of ratio like that. They do get a sense of efforts to have a smaller government. And the other thing, though, in line with that, is antitrust. And I think that's partly why, when the election results became clearer, that we saw bank stocks rally strongly, not only for their deal-making capacity, but also that the Biden administration has had really a more rigorous antitrust action. It's brought a lot of criticisms to the Federal Trade Commissioner. And so I think that we're going to see a more lenient environment for M&A activity. And this includes then more lenient rules than for private equity, including that the tax proposals, they'll make it more lucrative in the private equity space.
Very good points there. With both the House and the Senate being majority Republican, how does this affect expectations for policy changes in the next 2 years?
I mean, it's quite amazing when you think about what's happened. The Republicans have gotten this whole sweep like in 2016. However, when everything's said and done, it still looks like the Senate and the House are very close. And there's a lot of votes that require more than a majority. However, key issues, especially around the budget, taxes, and especially thinking about the extension of the 2017 Trump tax cuts, that having both houses allows a parliamentary maneuver, the reconciliation, that allows the budget to be passed without getting 60% of the Senate votes. It allows a simple majority. So basically, as one would suspect, right, that both houses and the executive, controlled by the same party, will allow easier passage of their agenda, which you'd expect in a democracy. It was popular vote, both houses of Congress, the executive branch, they'll be able to pass a good part of what they want.
Yeah, and I would agree with that. And I think even before we talk about Congress and the election, I mean, you talk about from a regulation perspective, Mark, it'll definitely be a lot easier with Trump being able to put some of the leadership positions in place and with the cabinet to make some of those moves on the regulation side of things. When it comes to legislation, definitely will be a lot easier being able to control both the House and the Senate and the presidency to get laws passed. I think even when we've seen, though, that we've had one party in control, as close as things are, it doesn't take a lot of votes to swing things one way or the other. A couple of Republicans flip, a couple of Democrats flip on their choice on a vote. And we've seen that in the past where you've had a couple of senators who don't necessarily like something that's in a bill and they'll hold it up. So while it should be significantly easier, there will still be some negotiating and maneuvering politically with certain members of Congress in order to get things passed.
So unlike before, though, I think about the the Affordable Care Act. And it was John McCain in the Senate, a Republican who, like you say, Steve, objected to the bill and was able to block it. He's not there anymore. And so I do think that the Republicans will feel emboldened by the electoral outcome and will really push and try to stay united, at least through the first 2 years.
Yeah, and I would expect in these first couple of years, we'll have minimal issues within the Republican Party because of the popular vote even. I mean, Trump basically won the popular vote by roughly 5 million. You've had pretty sweeping changes and flips in a lot of different districts. So I think we're going to see very minimal issues within the party, but that could still be something that comes up if there are certain controversial issues that are put forth within the Republican Party.
We did have a registrant question that I think is a good follow-up here. With Congress not even being able to fund the government without continuing resolutions, will they pass a tax law in 2025 that will extend the sunset provisions? Steve, I'm going to start with you on this one.
Yeah, I think that's a great question coming forth out of the audience. So we've seen a couple of pushes in the last few years to get some tax legislation passed, and they've all pretty much failed except for the Inflation Reduction Act. But we've also had some provisions even earlier this year, back in late January, early February, there was a bill that passed the House by a huge margin. Everybody expected it to pass the Senate fairly quickly, and it didn't. And a lot of those provisions, I think, are about extending these provisions from the Tax Cuts and Jobs Act. A lot of these things are going to expire, what the Republicans refer to as the big three: the bonus depreciation, fixing research and development credits, and fixing the interest deduction and limitation. I think those will very easily pass here fairly soon after the new government takes control. Sometime in 2025, we should see a bill that either extends or makes permanent some of these provisions, and including, during the campaign, Trump talked a lot about making permanent some of the Tax Cuts and Jobs Act provisions. And one of the things I always kind of talk about in our discussions here is, there's this Senate rule kind of called pay as you go. And what it does is it requires any bill going through the Senate to basically, on these tax cuts, to offset those with increases in taxes somewhere. I'm oversimplifying it greatly, but that's essentially how it works. Over a 10, 11-year period, it has to be kind of revenue neutral when it comes to these tax bills. That's why we have these provisions expiring after the Tax Cuts and Jobs Act. The way they were able to get the Tax Cuts and Jobs Act passed and be revenue neutral was they increased taxes in some areas, they decreased taxes in other areas. Well, some of those increases were made permanent. Some of the decreases only lasted 6, 7, 8, 9 years. And so over the course of that 10, 11-year period, they were kind of revenue neutral. What Trump has proposed here in the campaign is making a lot of those provisions that were beneficial to lower tax rates, the 20% deduction for qualified business income. A lot of these things that we saw as lowering taxes for small to medium-sized businesses, he's proposed making those permanent. And the way to offset that and increase revenue in other areas to make it revenue neutral is by increasing tariffs, especially tariffs to China. I think he said something like a 60% tariff on any products being imported from China. As a result of that, you're going to see not small, medium-sized businesses are going to see their tax bills lower, but they're going to see their cost of their materials increase. So from a net bottom line perspective, there might be a little bit of an offset there, but it should help from a tax perspective. Hopefully with the things we're seeing in the market, we'll see revenues increase. Hopefully we'll start to see bottom lines increase.
Yeah, that sounds pretty hopeful to me. I think that it's really, I don't think that the deficit, I think neither candidate really ran on reducing the budget deficit. I think that people like us might talk about the budget deficit, but at the end of the day, I don't think it's really become a powerful force in the market or really in politics. I think that if there was really a problem, if investors, global investors, and then again, who buys U.S. treasuries, and over a third of them, or around a third of them, are owned by non-Americans. And there hasn't really been a capital strike like there was, say, in the UK after the recent budget, where interest rates just soared, based just solely on fiscal issues. And so I think that many of us on the sort of professional economists and market observers worry about the deficit, but I don't think it's really a political force. And I don't think that Trump is really concerned about it. I think that one of his signature acts was this tax and jobs bill, and I think that he wants to make that as permanent as possible. And I agree that trying to offset that with tariffs, it may do something, but I'm suspicious of that, partly because in a dynamic way, the higher input costs would tend to mean to me a weaker economy. Weaker economy means lower tax revenue. So it's really got all these moving pieces, which makes it very hard to figure out what it ultimately means. But I do think that the tax legislation, the tax cuts, he wants to make permanent. But some of the tax ideas of Harris, like extending the the tax credits for children, I don't think that's going to go anywhere. And so I think what we're going to end up with that is more of the same of what we have. And I think that partly helps explain why the voting outcome was what it was. It seems like besides college educated as a key test of how people were going to vote, one of the other big tells was if people lived in a district, in a county, in which the per capita GDP has actually fallen. And that really speaks to the disparity of wealth and income in America. And I think that some of these measures are going to exacerbate that. And while it might solve a short-term political issue or economic issue, the longer-term society impact might be more challenging.
Very good points by both of you there. Could Trump have any changes in effect on the near future economy and thus impact the speed of change in federal funds rate? Steve, I'll start with you.
Yeah, that's a great question. I think some of the things we've talked about here, the tax cuts, the tariffs, some of those things are going to take time to work their way through Congress and get passed into law and then actually start to impact the economy. So, I mean, like we've talked about, the Fed is independent. Mark, I'll let you explain that a lot better than I can. But from my perspective, from what Trump can do in terms of legislation, that's going to take time. And then once that is passed and implemented, it's going to take time for us to see that impacting the economy. So from my perspective, I don't see a great change in the rates as a result of anything Trump can do in the immediate future. But Mark, you're a better person to answer that question than I am.
No, I agree with you, Steve. I think that, we all want things to happen like now. We have this maybe short attention span and need for immediate gratification. And the economy, especially one as large as the U.S., doesn't work that way. I think that what we're seeing happen, though, right? The Federal Reserve cut 50 basis points in September, another 25 basis points here in November. It looks like they're going to cut again in December, 25 basis points. But then they're going to slow down. In effect, what they did was cut 100 basis points September through December this year. And that's a lot in a small period of time. And I think that we should expect a slower pace next year. Maybe it's one cut a quarter, which turns into one at every other meeting, rather than here we're doing 3 meetings in a row, it looks like. So I do think we get a slower Fed, but I don't think it's really because of Trump policy. I just think it's the way, as Steve explained, that these things, that there's lag times for these things to take effect. We don't know the sequence in which legislation will be passed. We don't know what the results of the executive decisions. And the other thing we really don't know, this other unknown, is how the rest of the world will react. Even though we're such a large country, sometimes we act very insular, and we forget that other countries also have agency, and they might not like Trump's tariffs, and they might like tariffs themselves, or do other measures to restrict U.S. trade or to punish the U.S. And so so I think there's a lot of unknown, but I think that the best guess right now is, as Steve suggested, a continued gradual pace of easing of Fed policy to bring the policy rate back to something that's more neutral, from a very high level of restriction to a more neutral level, which the market, as of now, as we're speaking, the market's got about I want to say that they think that Fed funds are going to be, which right now are 4 3/4, they think could be 3 3/4 by the end of next year.
The potential presidential outcomes in each election are covered heavily, including how the economy is impacted. Let's get into some of the other key elected positions, starting with some areas that might not be voted on as much, like our state and local governments.
Yeah, we focused a lot in our conversation about the federal government, Congress, the presidency. We also need to be aware of the impacts from our state and local governments. Those impact our lives tremendously. And I'll give you a good example of that came up on a call I had with a client earlier this week. where the state that they were in passed a law that prevents the sale. So let me kind of back up a little bit. Like I said earlier, I work a lot with RV dealerships, and RVs, especially the larger RVs, are powered by diesel engines. So the state that this particular dealership was in passed a law that made it essentially illegal to sell a large vehicle with a diesel engine in it, basically making it illegal to sell the entire inventory that this dealership has. So we were having conversations about, what do they do? This law is already passed. It's on its way to being effective. And essentially, they need to move to another state. They're already looking at property in another state to relocate, while at the same time keeping their current location and trying to make the best of it as they can. So I think a lot of times, we talk about taxes, we talk about tariffs. The other things we need to keep in mind is, what are our state and local governments doing to us in terms of regulations, laws, criminal code, those types of things, especially as those would impact the specific industry that our clients are in.
Yeah, we just think that's really good insight, I think, because I think that a lot of our clients, small, medium-sized businesses, tend often to be more affected by state and local government rules and laws than they are by the federal government. And I think that, and we think of ourselves as the United States, but there's nothing really united about it in the sense of each individual state and local locality, they have their own rules, and it's really much more of a quilt and of a United States.
Yeah, and it's interesting because a lot of our voters, when you look at some of the statistics, clearly are focused very heavily on the federal government, Congress, and the presidency. One of the interesting stats that I saw was in some of these districts where Trump were able to flip some of these districts. It was interesting, the fact that if you look at vote totals between the federal government positions that were on the ballot versus the state and local positions that were on the ballot, there were hundreds of thousands more votes for the federal government positions than the state and local positions. In other words, people walked in, voted for president, voted for Congress, and then walked out without voting for any of the state positions. So I think a lot of times, to your point, Mark, people don't think about the great impact that state and local government has on their business and on their personal lives. We talk about those state regulations. When you look from one state to another, the client that I was talking about is literally looking at moving across the state line because where he's at, it's illegal to sell his inventory. If he moves 20 miles and crosses the state line, all of a sudden he can sell his inventory.
I'm kind of guilty of this as well. I mean, I think my wife teases me that I know more about what's going on in Japanese and German politics right now than I do about my own priesthood.
Yeah, it was interesting for me as I stood in line to vote. I spent the 2 hours that I stood in line to vote researching my local school board. I have kids in high school. So I spent that time researching the people that were up for the local school board because you see all these news stories about what's going on in our local schools. So it was just an interesting little factoid to me when I saw it, the discrepancy in vote totals between the federal government and the state and local governments. People literally walked in, voted for those federal positions, and then walked out without even casting a vote for state and local government positions.
Let's get into some of the other key elected positions, starting with Vice President-elect J.D. Vance. What are some of the expectations and responsibilities we should see Vance pushing?
Sure. So one of the things that I found very interesting, I talked earlier about this bill that passed the House pretty overwhelmingly earlier this year that had provisions for both Republicans and Democrats. Is a very bipartisan bill, but it went nowhere in the Senate. We're expecting it to pass with some of those Democratic provisions stripped out of it now that we've got a fully Republican Congress and presidency. But one of the things I found interesting is one of those provisions was an increase to the child tax credit. Mark, you kind of mentioned this earlier. But during the campaign, from a tax perspective, one of the things that J.D. Vance talked about was really wanting to increase that child tax credit even more than what the Democrats had in this bill that passed the House earlier this year. I think his proposal was increasing the child tax credit to $5,000 per child. That could be really significant for a lot of families, especially lower income families and families that have multiple children.
Yeah, I fully agree with on a domestic perspective. On the international perspective, I think that Vance has made two big points I think that are important. One, of course, he's endorsing the this high tariff regime that Trump has advocated. But also, it really raises the issue, I think, of since COVID, we've been talking about different strategies for businesses. And we talk about nearshoring. bring production close back to the U.S., where it be in friendly countries such as Mexico. And I think that both Vance and Trump seem to kind of reject that nearshoring. They seem to prefer onshoring. So, for example, both Trump and Vance have been critical of U.S. auto producers, for example, producing cars in Mexico, exporting them back to the U.S. Mexico exports something like 85% of their cars, and the U.S. gets about 90% of Mexico's exports. So, we're a big recipient of this. And of course, the USMCA, which Trump negotiated, had raised the domestic content rules. So it made it more rigorous. And I think that that's not good enough anymore for Trump and Vance. They want to see this production come back into the U.S. And so this, of course, next year, 2025, we'll begin reviewing the USMCA with reforms to be announced in 2026. So to me, one of the difficulties with this election, trying to interpret the meaning of it, it's not clear what is campaign rhetoric, how much of it is negotiating position, and how much of it is a principal position. But it does look like this effort of onshoring is a real principle. And this also involves then a difference between the Biden administration and, say, Chinese auto production. The U.S. says, we don't want Chinese autos. We don't want Chinese autos in the U.S. We don't want U.S. companies to be using Chinese software in our cars and our EVs for obviously national security reasons. However, the Trump administration, Trump has said in the campaign, he seems to be more sympathetic, basically allowing China to do what we allowed Japan to do. Remember in the 80s, we were being flooded, we thought, with Japanese automobiles. Detroit finally had some competition. And we all kinds of protectionism, all kinds of efforts to try to slow down Japanese exports, auto exports, parts exports into the U.S. The eventual solution, which I think Trump is embracing towards China, is have Japanese car producers produce in the U.S. Have them hire our workers, produce locally, sell locally. So it's really a foreign direct investment strategy as opposed to the export-oriented strategy that's been prevailing, really is. Not so much in the U.S., but many other countries. And so I do think that in this way, Trump-Vance administration has the potential then to really shake things up and to really force other countries to give up their export-oriented strategies and adopt this foreign direct investment strategy, which U.S. companies have done since for more than 50 years now. U.S. companies service foreign demand primarily by building abroad, selling abroad. This is an exception. I mean, Japan is like this now too, after that protectionism and the sharp appreciation of the yen. China is not there. Germany's not there. And so I think that there is a chance that the Trump administration, Trump and Vance, are going to really tighten the screws and get other countries to begin pursuing a direct investment strategy than this export orientation.
We know a big difference between Trump and Harris were tax laws, specifically the expiration of the Tax Cuts and Jobs Act at the end of 2025. With a Trump presidency, what is the expected status of the TCJA? Steve, I'll start with you.
Yeah, that's a great question. There's been a lot of concern over the last few years, and as we were getting into the election day, expecting the federal government to be split, there was a lot of concern about these provisions that were going to be expiring from the Tax Cuts and Jobs Act. There's been a lot of planning around that across the country for small to medium-sized businesses. Now, knowing that the House, the Senate, and the presidency are going to be controlled by the Republicans, the expectation is that a lot of those provisions are not only not going to be allowed to be expired, but a lot of them are going to be made permanent, and there are going to be some additional changes on top of that. So our expectation is that the expiring provisions of the Tax Cuts and Jobs Act will be made permanent sometime within the next year or so, within the first year of the Trump presidency. But then also we'll have some additional changes. So for example, right now there's a $10,000 limit on the amount of state and local taxes that can be deducted as an itemized deduction on a personal return. Trump said during the campaign he wanted to remove that cap and allow a full deduction for all of those state and local taxes that are being paid. So our expectation is that hopefully within the first year of the presidency, we'll have another major tax bill similar to the Tax Cuts and Jobs Act, but essentially making those provisions permanent.
I'm not quite as hopeful on the SALT deductions, partly because I look at an electoral map, and many of those high tax states here on the East Coast or on the West Coast are ones who would benefit the most, and they didn't vote for Trump. And I think there's a sort of a vengeful spirit, and if you did help him, why should he help you kind of attitude. But I agree with you that there could be other efforts made to try to strengthen the economy. And I think one of these might be the accelerated depreciation allowance. Allow businesses quicker to deduct their capital investment, which is a key to boosting productivity.
Yeah, I agree. On the state and local taxes, that's definitely an issue because those more blue states tend to have higher tax rates, which means their constituents are paying higher taxes, and this cap is not allowing them to deduct those taxes. So this is kind of trying to bring those states in a little bit more, maybe a little more Republican control in those states, allowing them to make those deductions and showing that the Republicans were the ones that allowed this to happen. The other part of it, though, from a business owner perspective, a lot of those states have implemented what they call a workaround, and have implemented what we call pass-through entity taxes. So what that means is the state is allowing the company, the flow-through business, to pay those state taxes, which flows through in a different way on your personal return for the owners and doesn't become an itemized deduction, so it's not subject to that $10,000 limit. So essentially, that $10,000 limit for small business owners isn't really a limit anyway. There's just all this extra work and returns and paper filing and administrative costs that have to go into getting there. So if over the last few years, if we found a way to work around it, well, why have the cap in the first place? So it's just a big administrative cost and a big administrative headache. So I think part of eliminating that cap is the fact that it's not really a cap anymore. It just creates a lot of administrative nightmare for a lot of business owners. So the other thing you mentioned there, Mark, was the accelerated depreciation. So over the last few years, we've seen the bonus depreciation amount be decreased every year. It's in the process of being phased out. Our expectation is that should go back up to 100%. We'll have that bonus depreciation going forward. But the other major provision that kind of goes along with that, and that should help the economy, and Mark, maybe you can give us your thoughts on this as well, but currently under the law, because of some provisions that changed as part of the Tax Cuts and Jobs Act, is the deductibility of research and development expenses. So here in the United States, companies spend a tremendous amount of money on research and development to improve their products. Well, currently under the law, you can't deduct those expenses. Historically, for as long as anybody can remember, we've been able to deduct those expenses in the year that they were incurred. Well, right now, starting a couple of years ago, you actually have to capitalize those expenses. And if those expenses were incurred inside the United States, you have to amortize that expense over a 5-year period. If they were outside the United States, you amortize them over a 15-year period. So if we want to spur the economy and we want to create that innovation that we're familiar with here in the United States, we need to be able to allow businesses to deduct those expenses, because a lot of businesses, based on their economics, have kind of pulled back some of their research and development because they can't get the full deduction for those expenses. Mark, I don't know if you've seen that from a broader economic perspective.
No, but I agree with you, Steve. I think that's really the focus. I think I saw a commercial that said something like, we don't focus on success. We focus on the things that lead to success. And I think that's true about what you're saying about R&D, that if we want to have a strong economy, want to be on the cutting edge, we might be slipping behind some things like EV batteries or automated driving vehicle. But so I think you're right that to really reinvigorate, reanimate the economy, a real key thing is making it easier and cheaper for businesses to develop their new products and new ideas and innovations. And that's really a break on R&D investment.
Though the outcome of the election is here, there are still constant uncertainties in our world that affect the market, businesses, and our personal lives. How can business owners stay aware and ahead of what's happening while also working and growing their companies during uncertainty? Mark, I'll start with you.
Yeah, I don't think there's any easy answer to it. I think there's a question of, for me, I think it's a key issue is really separating what one wants to believe is the case from what the data is telling us. And so it's the ability to be like eyes wide open, respect the data. The U.S. government has an economic report almost every day of the week. And over time, the shape and direction of the economy becomes clearer. And so I think it's really a focus on adding value. And I think that means the things that, like Steve was talking about with innovation, research and development, stick to one's knitting. Know what one does well, know what one does better than their rivals, and stick with that.
Yeah, I agree. I think if we have our small business owners, small and medium-sized businesses focusing on what they do best, what brings value, what they can sell to their customers, that's where their focus needs to be. I think where they can help themselves with what you're talking about with the market and their business and personal lives is focus on those things. Focus on the business, focus on what you do well, and specialize in what you're doing. We see a lot of value in specialization, but then surround yourself with the people that specialize in those areas that you don't. So have somebody like Mark, who's a specialist in the economy and in the marketplace. Work with your CPA, your attorneys. Keep informed, but really rely upon those people that specialize in those areas, so you're not having to spend a tremendous amount of your time educating yourself on what's coming and what you need to do and change differently. Have regular communication, regular meetings with your advisors that are the experts in those areas and know what's coming and what you need to do, and let them handle those situations so you can focus your time specifically on your business and growing the value within your business. So one great example of this is recently Congress passed a law that required beneficial ownership information reporting. It kind of looks like a tax return, but it's not a tax return. It's more of a legal issue. It's reporting basic information about the beneficial owners of a business. There's a lot of exceptions, a lot of definitions, a lot of back and forth, but there was not a lot of publicity about that. And so what we're finding now, because this is more of a legal issue, not a tax issue, so our firm has taken the position it's not something we can do for our clients. In fact, the federal government has come out and provided a website, makes it very easy to provide this information, takes about 10 to 15 minutes if you have the information readily available. But that's another example of if you weren't paying attention and didn't know, business owners aren't going to realize, and there are huge penalties for not doing this. And so if you're not staying aware and talking to those advisors on a pretty regular basis, you're going to miss something that you're now required to do because you haven't heard about it. Whereas your advisors, the people that are the experts in their areas, should be very aware of it and should know exactly what you need to do. Hopefully your advisors are reaching out to you in those situations, but it's also very smart to make sure you're meeting regularly with those advisors and asking the question, what's new? What's something I need to be aware of that I might not know about?
Yeah, I agree fully, Steve. I think that relying on trusted advisors is really a key, especially for small and medium-sized businesses, but also as households. As households, I think we rely on our trusted advisors, our accountants, our lawyers, our doctors. I think the same thing true even at Bannockburn. We rely heavily on what we regard as our trusted advisors, accountants, lawyers, industry experts. I would add another factor for businesses to keep in mind, besides relying and trusting, building that solid, trustworthy relationship with these advisors, is really thinking about risk mitigation. I think we all know how good it feels when our football team wins, or when the candidates we pick win the race, or when the markets move our way. The challenge really is not when things move our way, but when things don't move our way. And we can't count on things always moving our way, especially in the markets. So I think that keeping in mind what risks can be managed and what risks are just part of doing business. Having succession planning, that's a risk that can be managed. Interest rates, a risk that can be managed. Currency volatility, a risk that can be managed. Whether China invades Taiwan or not, that's not a risk that can be managed. So I think really thinking about the businesses as well as households, thinking about what risks we face, what risks we can manage, and what risks we have to just be aware of.
Yeah, and something I would add to that is thinking a little more long-term. Most businesses do, 1 year budget, 1 year projections, maybe 3 years at most for some businesses. I mean, we're recommending to a lot of our clients now to do a minimum of 5 years. We've seen in the last 5 years such volatility, not only in the marketplace, but in the regulations and in the tax code, that you really have to be looking out farther than 1 to 3 years. And you've got to be able to plan for what if something changes. For example, my RV dealers back in 2020, 2021, they were having record years. Well, then we had high inflation, Fed started raising interest rates, consumers started buying fewer RVs. I have clients that 2 years ago were bringing, I'll just make up numbers here, $5 million to the bottom line that last year lost $1 million. So if you're not planning for those types of scenarios, you're not going to be able to survive when you have those types of issues that pop up. My guy that had the change in regulations where he's no longer allowed to sell diesel, that was a risk that could have been identified with a 5-year look at his business, because part of what you do as part of that process is where are your concentrations. Well, that would have been something that's identified that, hey, do you realize 95% of your sales are of diesel vehicles? What if the government comes back with some kind of environmental protection law that says you're no longer allowed to sell diesel vehicles? And we could have planned for that and started mixing up his inventory that maybe would have been allow him to stay in that particular location rather than having to change states last minute because of a regulation change that hadn't been planned for. So it's those types of things where you've got to be able to anticipate what those issues are and try and plan for them ahead of time rather than be reactionary when something does take place. So by putting together that 5-year plan, you can identify those potential risks.
Those are some great both personal and business real-world examples there of why you should be using the specialists. As we wrap up and think about going into 2025, into a new presidential term, what are the 3 main trends you expect that business owners need to be aware of? And what do they need to be doing now to prepare? Steve, I'll start with you.
Yeah, sure. So as we've seen over the last few years, the world has become so complicated. The pace of change has increased so greatly that, again, kind of as we've already talked about, being able to plan for that, being able to look at what potentially could be coming down the road and identify how you want to react to that now, be proactive rather than reactive. So what are the things that are coming down the pipe over the next 3 to 5 years? What are the potential things that could be coming down the pipe over the next 3 to 5 years? And then try and put a plan in place now and start taking steps now to put yourself in a position to be successful if and when those things do occur.
For me, I can sum up in one word. That's the businesses should prepare for volatility. Now, volatility, I mean change. And whether it's technology change, policy changes, the geopolitics, there's this ancient Greek story where it says that if a person had a lever long enough and place to put his feet, he could move the world. And the problem we have is we have long enough levers. But the problem is we don't have any solid place to put our feet. The idea of the U.S. is after the Cold War ended, this hegemonic unit power movement, that's faded. The idea that the thing that we became used to on technology, look at what not only internet, but the social media has done. These are changing business plans, changing marketing ideas. So much has changed in such a short period of time that I think that businesses like ourselves, individuals, we talk about individual level to be resilient. Be able to have setbacks without being defeated. I think the same thing with businesses. Businesses have to build into their DNA resiliency in a world in which is dynamic, changing, the values change, the politics change, the technology changes.
Well, thank you both for being here today and sharing your insights for our audience. Thank you to those who tuned in and submitted questions. We appreciate your viewership this year. Stay tuned for more from us as we head into 2025 with new content and new guests. Thanks again.